He didn't tweet, he didn't go on TV, he didn't warn anyone, but quietly, while the world was celebrating silver's explosive rise, one man was doing the opposite. A Chinese billionaire who rode gold's greatest rally, turning conviction into $3 billion, is now betting that silver collapses. Not a small bet, not a hedge, a position so large, it could shake an entire market. And if he's right, this move won't just surprise traders. It could rewrite everything you think you know about silver. But if he's wrong, the consequences will be historic. Welcome to Market Metal. If you've been watching markets for decades, if you've seen cycles come and go, and you value calm truth over noise, then consider subscribing, not for hype, but for clarity when markets get loud. And before we continue, tell us in the comments, from where in the world are you watching this video? Let's begin. The signal hidden inside a single trade. In global markets, the most important signals rarely come from headlines. They appear quietly inside positions that are too large, too patient, and too deliberate to be ignored. This story begins with one such signal. It is not about fame or prediction. It is about behavior, structure, and timing, three forces that serious decision makers watch when markets move from order to instability. At the center of this signal is Bian Shiming, a Chinese trader who spent years building one of the most successful gold positions of the modern cycle. He did not become known through television interviews or social media posts. He avoided attention, worked through brokerages, and allowed time, not publicity, to validate his thesis. From early 2022 onward, as inflation fears spread and central banks accelerated gold purchases, his conviction aligned with macro reality. The result was nearly $3 billion in gains tied to gold contracts on China's futures markets. For most observers, that success alone would be the story. But markets are not driven by past wins. They are driven by present positioning. And today, the signal is not what he made on gold. It is what he is doing now against silver. Silver is often treated as gold's sibling. In media narratives and retail portfolios, the two metals are bundled together under the label precious metals. When gold rises, silver is expected to follow, usually with more speed and volatility. When gold is discussed as a hedge, silver is often presented as a leveraged version of the same idea. This mental shortcut is widespread. It is also dangerous. Professionals know that gold and silver are structurally different markets. Gold is primarily monetary. Central banks buy it. Sovereign reserves hold it. Its demand responds to interest rates, currency confidence, and long-term risk management. Silver, by contrast, is a hybrid. It is partly monetary, but heavily industrial. Its price is influenced by manufacturing cycles, speculative leverage, and futures positioning. This difference matters most during moments of extreme movement. In recent months, silver experienced a rapid, aggressive surge. Prices rose sharply in a short period, drawing attention from traders, funds, and retail participants. The narrative became confident. Industrial demand was cited. Energy transition themes were amplified. Momentum built on itself. In such environments, participation increases not because risk falls, but because fear of missing out rises. It was during this phase, when confidence was highest and price action was most vertical, that Bian Shiming changed posture. After previously holding long exposure to silver, he began building a large short position on the Shanghai Futures Exchange. Not a small hedge, not a tactical trade, a position that grew to roughly 450 tons of silver, spread across tens of thousands of contracts. This is where the signal emerges. Large traders do not add size casually. In futures markets, size increases risk nonlinearly. Volatility expands margin requirements. Price swings can force liquidations even when the thesis is correct. A short position, especially during a rising market, carries asymmetric danger. Losses can be theoretically unlimited. Professionals know this. That is why extreme short positions are rare at moments of optimism. Yet this position was built deliberately, over days, and maintained through volatility. According to analysis of exchange data and people familiar with the trades, the position became the largest net short on the exchange. When silver prices finally reversed and fell sharply, the paper gains reached hundreds of millions of dollars. But focusing on profit misses the deeper message. This trade is not a call that silver must fall. It is a statement about fragility. Markets often confuse price movement with strength. A fast rise feels powerful. A parabolic chart looks convincing. But experienced operators view parabolic moves with caution. They know that speed often reflects leverage, not durability. When too much positioning depends on continued momentum, the system becomes sensitive to shocks, margin changes, liquidity gaps, or shifts in narrative. The gold trade that built Bian's reputation was the opposite of this. It was slow, aligned with policy, and supported by central bank behavior. It benefited from long-term forces rather than short-term positioning. The silver trade, by contrast, appears to be a bet that recent gains were driven more by structure than substance. This distinction is critical for business leaders and investors. The most dangerous periods in markets are not when risk is obvious, but when it is masked by confidence. When narratives become uniform, dissent becomes scarce. At those moments, the actions of disciplined capital matter more than commentary. Importantly, this is not about copying a trade. Large positions on Chinese exchanges are inaccessible to most global investors. It is about understanding why someone with a proven track record would choose this moment to move against consensus. Professionals do not seek to be contrarian for its own sake. They seek mispricing created by behavior. Silver's market structure amplifies this behavior. Compared to gold, silver futures are thinner, more volatile, and more sensitive to forced selling. When prices rise quickly, leverage accumulates. When prices fall, liquidation accelerates. This feedback loop can turn modest reversals into violent drops. A trader betting against silver at a peak is not predicting the future. He is positioning for instability. The timing also matters. This shift did not occur in isolation. It happened amid broader questions about global growth, liquidity conditions, and the durability of speculative rallies. It occurred while gold remained elevated, supported by macro demand, even as silver surged faster. That divergence itself is a signal. For decision makers, the lesson is not about metals alone. It is about cycle awareness. In every asset class, late-stage moves attract narratives that justify price rather than examine structure. Industrial demand stories, technological transitions, and supply constraints can all be real and still insufficient to support leveraged price action. By turning from gold to silver in this way, Bian Ximing is not abandoning precious metals. He is separating them. He is expressing a view that one market remains anchored to long-term forces, while the other has become exposed to short-term excess. That separation challenges the common assumption that metals move together. As this series continues, the focus will not be on whether this trade ultimately profits further. Markets are probabilistic, not deterministic. The focus will be on what this behavior reveals about the current phase of the cycle, the mechanics beneath price moves, and the risks faced by those who confuse momentum with stability. The central question remains unresolved. When experienced capital steps away from consensus and accepts visible risk, is it early, or is it responding to cracks that others have not yet noticed? That question, more than any forecast, is the true signal hidden inside a single trade. Structural fault lines beneath the silver rally. Markets rarely fail where attention is focused. They fail where assumptions go unquestioned. To understand why an experienced trader would take a massive position against silver at the height of enthusiasm, it is necessary to move away from personalities and toward structure. What matters here is not who placed the trade, but what kind of market allows such a trade to make sense at all. Silver is often described as gold with leverage. That phrase sounds attractive, but it hides more than it reveals. Gold and silver may share a history, but in modern markets they operate under very different rules. Confusing the two creates blind spots, especially during periods of rapid price movement. Gold is a reserve asset. Its demand is anchored by institutions that move slowly and think in decades. Central banks buy gold to diversify reserves, hedge currency risk, and signal stability. These buyers are not sensitive to daily price fluctuations. They accumulate during weakness and hold through volatility. This behavior dampens extremes. Even during sharp corrections, gold tends to find support from long-term holders. Silver does not have that anchor. While silver is sometimes framed as a monetary metal, the majority of its demand comes from industrial use: electronics, solar panels, medical applications, and manufacturing. This demand is cyclical. It depends on growth expectations, capital spending, and global trade. When economic momentum slows, industrial demand softens. Unlike central banks, factories do not buy through downturns out of conviction. They adjust orders quickly. This dual identity, part monetary, part industrial, makes silver structurally unstable during speculative phases. When investors rush in, they are often responding to narratives rather than fundamentals. Industrial demand becomes a justification rather than a driver. Price leads the story, not the other way around. The futures market amplifies this instability. Silver futures are thinner than gold futures. Liquidity is lower. Volatility is higher. Small shifts in positioning can produce outsized price movements. This environment attracts leverage. Traders use futures not to own silver, but to control exposure with minimal capital. As prices rise, margin requirements increase, but enthusiasm often rises faster. Positions stack on top of positions. The market becomes top-heavy. At this stage, price no longer reflects balance, it reflects tension. One of the most overlooked aspects of futures markets is forced behavior. Traders like to believe they act freely. In reality, margin rules, volatility limits, and liquidity constraints make many decisions automatic. When prices move against a leveraged position, the choice is not strategic. It is mechanical. Positions are closed because they must be closed. This is where silver differs sharply from gold. Gold's deeper liquidity allows large players to adjust without triggering cascades. Silver does not offer that luxury. When selling begins, it often accelerates. Stops are hit, margins rise, liquidity thins. What started as a pullback becomes a liquidation. A short position placed into this structure is not a prediction that prices will fall tomorrow. It is a recognition that the system cannot absorb stress smoothly. Another critical difference lies in the composition of participants. Gold markets are dominated by institutions, central banks, and long-term allocators. Silver markets attract a higher concentration of speculative traders, short-term funds, and momentum-driven participants. These actors respond quickly to price signals and narratives. When sentiment turns, they exit together. This crowding effect creates vulnerability. During silver's recent surge, positioning data showed rapid increases in futures exposure. Volumes rose sharply. Open interest expanded. These are not signs of stable accumulation. They are signs of speculation. In isolation, speculation is not dangerous. Markets need participants willing to take risk. The danger arises when speculation becomes one-directional. At that point, the market depends on continued belief. Professionals watch for this moment closely. They do not wait for headlines to turn negative. By the time narratives shift, the opportunity is often gone. Instead, they look for asymmetry, situations where risk and reward are no longer balanced. In silver, that asymmetry appears when price rises faster than liquidity can support, when leverage outpaces demand, and when volatility becomes the primary driver of participation. In such conditions, even good news can fail to push prices higher. That is often the first sign that structure, not sentiment, is in control. The industrial argument for silver is often presented as a shield against this risk. Solar demand, electrification, and technological growth are cited as reasons prices must rise. These factors are real, but they operate on long time frames. Futures markets operate on short ones. A long-term demand story does not prevent short-term liquidation. In fact, it can encourage it by attracting speculative capital that assumes support will appear automatically. This mismatch between time horizons is where many participants misjudge risk. A large short position placed during peak enthusiasm suggests that the trader believes this mismatch has reached an extreme. It implies that recent buyers are not anchored by fundamentals, but by price action. When price stops cooperating, their positions become liabilities. It is important to note that this does not mean silver is over as an asset. Markets move in cycles. Corrections do not invalidate long-term trends. But cycles have phases, and late phases are marked by confidence, speed, and dismissal of risk. The most powerful warning signs are behavioral. And when participants stop asking what could go wrong, something usually does. This is why separating gold from silver matters. Treating them as one trade assumes shared structure. They do not share it. Gold's buyers can wait, silver's often cannot. Gold's support is institutional, silver's is conditional. Gold absorbs shocks, silver transmits them. A trader who understands this difference does not need to predict a collapse. He needs only to recognize that the market has lost balance. In such environments, even small triggers can produce large outcomes. As silver prices began to slide, the reaction was swift. Losses forced liquidations. Volatility spiked. The very leverage that powered the rise accelerated the fall. This behavior did not require a new narrative. It required only the removal of momentum. For observers, the question is not whether this move continues. The deeper question is why so many participants were positioned in a way that made continuation necessary. When markets reach that point, risk is already embedded. In the next phase of this analysis, attention will turn to timing and psychology. Why experienced operators act when uncertainty is highest, not lowest, and why the most dangerous moments often feel the safest. For now, the structural fault lines are clear. Silver's rally was fast, leveraged, and crowded. Gold's remained measured and supported. When those two paths diverge, it is not noise. It is a signal. Whether that signal has finished transmitting or is only beginning remains an open question. Timing the crowd. When professionals act and everyone else hesitates, markets do not turn when fear is loud. They turn when confidence is absolute. By the time most participants feel safe, the conditions that created safety are already disappearing. This is the paradox at the heart of every major market move, and it is where experienced operators separate themselves from the crowd. To understand why a massive bet against silver emerged at the height of enthusiasm, one must understand timing, not in days or weeks, but in psychology. Professional capital does not wait for confirmation. Confirmation is expensive. It arrives only after opportunity has faded and risk has transferred to late participants. Instead, disciplined traders act when uncertainty is highest. When price is violent, narratives are strong, and positioning is crowded. Silver's recent behavior fits this pattern precisely. As prices accelerated, confidence did not merely rise, it hardened. Commentators spoke of new eras. Industrial demand stories became dominant. Volatility was reframed as strength rather than warning. Each pullback was bought aggressively. This is not unusual. It is how late-stage moves behave. What matters is not that optimism existed, but that it became one-sided. In such conditions, timing is not about predicting a top. It is about recognizing when the market's ability to absorb risk has diminished. This is where volatility plays a central role. Volatility is often misunderstood as randomness. In reality, it is information. Rising volatility signals disagreement. Falling volatility during a rally signals consensus. When price continues to rise, while volatility compresses, it suggests that participants believe risk has declined. That belief is itself a form of leverage. Silver's surge compressed perceived risk while expanding actual exposure. Leverage built quietly. Futures positions increased, margin usage climbed. Many participants assumed that liquidity would always be available, that exits would be orderly if needed. This assumption is rarely tested during rallies. It is tested only when prices reverse. Professional traders focus on this moment. They know that markets do not fail because fundamentals suddenly vanish. They fail because too many participants need the same exit at the same time. When that happens, price discovery breaks down. Liquidity disappears. Decisions become forced. Shorting into this environment requires patience and discipline. Losses can appear quickly. Price can continue higher longer than expected. The psychological pressure is intense. This is why such positions are rare. Only traders with deep capital, long time horizons, and strong conviction can hold through the noise. This is also why these positions are meaningful signals. The short position against silver was not built in a calm market. It was built during chaos, when prices swung violently and narratives grew louder. This suggests that the trade was not reactive, it was anticipatory. It assumed that volatility itself would become the catalyst. History supports this approach. Major reversals are often preceded by volatility spikes that shake confidence without breaking price. These spikes force weak hands out while convincing strong hands that the market is resilient. Participation becomes more concentrated. Risk accumulates in fewer, larger positions. At that point, the system becomes fragile. Silver's market structure magnifies this fragility. Compared to gold, silver responds more sharply to margin changes and liquidity constraints. When exchanges adjust requirements, or when volatility increases, participants must post more capital or reduce exposure. This creates a feedback loop. Price moves force behavior, behavior moves price further. Professionals watch for this loop to tighten. The timing of the short position suggests an expectation that this loop was near activation, not because of a specific event, but because of crowding. When everyone agrees on direction, disagreement becomes profitable. Another critical factor is narrative exhaustion. Every rally relies on stories to attract participation. Early in a move, narratives are cautious. Later, they become confident. Eventually, they repeat themselves. When arguments stop evolving, the market is often near transition. Silver's industrial demand story, while valid, began to serve as a catch-all explanation for price rather than a measured analysis. That is a warning sign. Professionals are not immune to narratives, but they treat them as secondary. Price structure, positioning, and behavior come first. When narratives grow louder while structural conditions weaken, experienced operators prepare for reversal, not because they know the outcome, but because the distribution of risk has changed. This distinction matters for business leaders and investors. Timing is not about speed. It is about positioning relative to others. Late participants often believe they are early because price has not yet fallen. In reality, they are late because everyone who wanted to buy has already bought. This is why parabolic moves are unstable. They require continuous inflows. When inflows slow, even briefly, the structure collapses under its own weight. Silver's sharp decline following its peak was not caused by new information. There was no single headline that reversed sentiment. Instead, the market simply lost momentum. That was enough. Stops were triggered, margins tightened, liquidations followed. What felt like strength became vulnerability almost overnight. From the outside, this can look sudden. From the inside, it is predictable. Professionals do not need to know the exact day of reversal. They need to know that reversal risk has become asymmetric. When potential downside outweighs upside, positioning changes, even if price has not yet confirmed it. This is the uncomfortable phase of every cycle. Those who act here appear wrong until they are right. Those who wait for clarity feel safe until they are forced to act. Markets reward the former over time, not because they are smarter, but because they respect structure over sentiment. The silver short embodies this philosophy. It reflects an understanding that the market had reached a point where timing favored caution, not continuation. Whether the move extends or stabilizes is secondary. The primary signal lies in the willingness to take visible risk against consensus. For observers, the lesson is not to follow the trade. It is to examine their own positioning. Are decisions being driven by fundamentals or by fear of missing out? Is risk being managed or assumed away by narratives? These questions matter far beyond silver. As this analysis moves forward, attention will shift from psychology to implications. What does this divergence between gold and silver mean for broader markets? What does it suggest about liquidity, speculation, and the next phase of the cycle? The answers are not yet clear. That uncertainty is precisely the point. When experienced capital moves quietly against the crowd, it is rarely a declaration of certainty. It is an acknowledgement that the balance of risk has changed, and that is often the most important signal of all. what this trade reveals about the next phase of the cycle. Markets rarely announce transitions. They drift into them quietly, while attention remains fixed on prices rather than conditions. The significance of a large bet against silver is not that it predicts a specific outcome. It is that it exposes a shift in where risk is accumulating and where it is being quietly avoided. At this stage of the cycle, the most important question is not whether silver will fall further or recover. The question is why experienced capital chose separation instead of alignment. Why step away from a trade that had captured global enthusiasm? Why break the assumed unity between gold and silver when narratives insisted they should rise together? The answer lies in liquidity. Late cycle markets are defined less by fundamentals and more by access to capital. When liquidity is abundant, risk tolerance rises. When liquidity tightens, leverage becomes a liability. Silver's recent behavior suggests that liquidity sensitivity has increased. Small shocks are producing large responses. Volatility is no longer being absorbed. It is being transmitted. Gold, by contrast, remains insulated. This divergence matters. It suggests that capital is no longer treating all inflation hedges equally. Instead, it is discriminating, favoring assets with institutional sponsorship over those dependent on speculative participation. This does not mean gold is immune to correction. It means that its downside dynamics are different. Support arrives differently. Risk is distributed differently. For silver, the implications are more complex. A market that relies heavily on futures positioning is vulnerable to rule changes, margin adjustments, and sentiment shifts. These forces are external to fundamentals. They operate mechanically. When volatility increases, exchanges raise requirements. When requirements rise, participants reduce exposure. When exposure falls, price declines further. This chain reaction does not require bad news. It requires only stress. The recent sell-off demonstrated how quickly this process can unfold. Importantly, this does not invalidate long-term demand arguments for silver. Industrial usage, technological applications, and energy transition themes remain relevant. But relevance does not equal timing. Long-term stories do not protect short-term positions from forced behavior. Markets can move far below perceived fair value when liquidity is constrained. This is where many participants misjudge cycles. They assume that because a narrative is true, price must behave rationally. In reality, price often behaves structurally. It responds to positioning, leverage, and rules before it responds to logic. The short position against silver can therefore be read as a diagnostic tool. It tests the market's resilience. If prices stabilize and recover smoothly, it suggests that leverage has been cleared and structure restored. If volatility persists and liquidity remains thin, it suggests that the unwind is incomplete. Neither outcome is guaranteed. What matters is preparedness. For business leaders, investors, and entrepreneurs, the lesson extends beyond metals. Late cycle environments reward caution, flexibility, and balance sheet awareness. They punish rigidity and overconfidence. Assets that performed well in one phase can underperform sharply in the next, not because they are flawed, but because conditions have changed. The separation between gold and silver may be an early sign of this transition. Historically, divergences within related asset classes often precede broader adjustments. When correlations break, it signals that capital is reassessing risk rather than chasing returns. This reassessment is rarely visible in headlines. It appears first in positioning data, in quiet reallocations, and in trades that seem uncomfortable at the time. The discomfort is the point. When markets feel easy, risk is usually high. When they feel difficult, risk is often being reduced. The current moment sits uncomfortably between those states. Confidence has been shaken, but not fully reset. Narratives persist, but cracks have appeared. Participants are divided between those expecting a quick rebound and those preparing for deeper adjustment. This division creates opportunity, but only for those who respect uncertainty. The silver trade does not claim to know the future. It acknowledges that the past is no longer a reliable guide. It recognizes that leverage has accumulated and that liquidity is no longer guaranteed. It accepts short-term pain in exchange for exposure to structural imbalance. That mindset is instructive. Rather than asking whether silver will rise or fall next, observers should ask more durable questions. Where is leverage concentrated? Who is forced to act under stress? Which markets depend on continuous inflows to remain stable? Which assets are supported by long-term holders rather than momentum? These questions matter more than price targets. As the cycle evolves, clarity will emerge, but only after positioning has adjusted. By the time consensus forms, opportunity will have shifted elsewhere. This is why experienced capital acts early and explains later. The goal is not to be right publicly, but to be positioned correctly privately. The divergence between gold and silver may resolve quickly, or it may widen further. Either outcome will reveal something important about the state of liquidity, speculation, and risk tolerance. What should not be ignored is the signal already sent. Capital is becoming selective. In markets, selectivity is often the first step away from excess. Whether this marks a temporary reset or the beginning of a broader transition remains uncertain. That uncertainty is not a weakness, it is information. Those who learn to read it are better prepared for what comes next. The cycle is changing. The only open question is how many participants will recognize it before price forces the lesson.